Have you ever heard someone says negative gearing sucks? Or why would you lose $1 to get 30 cents back? Well, as an accountant, I can tell you that's not the full story of negative gearing. In fact, those kinds of statements are often just marketing messages floating around the internet designed to sell you something. Stick around until the end because today I'm going to unpack what negative gearing actually is and why some of the wealthiest Australians do it on purpose. Hi everyone, I'm Eric Lee, property-focused accountant and real estate agent. You are investing or thinking about investing in properties, you probably heard the term negative gearing. Some people love it, some people hate it, but truth, most people don't really understand it properly. First of all, let's talk about what negative gearing actually is. Negative gearing happens when the total cost of owning an investment property, things like interest on loan, maintenance, property management fee, and the depreciation, etc., exceeds the income you earn from rent. So yes, technically, you are making a loss. But here's the key. That loss can reduce your taxable income. That means ATO gives you the portion you lost back to you in form of tax refund. Oh, wait. Then the statement, losing $1 to get 30 cents back is true, isn't it? Not really. The phrase completely ignores the capital growth, which is the huge part of the property investment picture. Actually, it is the actual goal. Yes, if you're negatively geared and your property doesn't go up in value at all, that's really bad investment. And I actually have seen quite a few actual cases of this with high-rise apartments. But what if you lose, let's say, $10,000 in rentals, but the property value increases by $50,000? So you're down $10,000 in cash flow, but up $50,000 in equity. So your net wealth has actually gone up by $40,000. And top of that, you can get around $3,450 back from the ATO, assuming that you're in like 32.5% tax bracket plus 2% Medicare levy. Your tax refund is a bonus. And here's something else. If you buy a brand new property, I'm not saying that brand new property is a good one, but you can claim depreciation on things like oven and air conditioning, carpets and blinds and etc. These are non-cash deductions, meaning you don't have to pay for it, but you can claim it as a tax deduction. It is like getting tax refund for a gift. Who doesn't love free stuff? I do. In the end, if your property grows in value more than the amount of your negatively geared after-tax benefit, it's not really negative at all. In fact, it can be a smart strategy to grow your wealth. You may wonder why people don't buy positive cash flow property then. With today's interest rate, around 6-7% or even 8%, finding positive cash flow property is tough. Unless you put down a large deposit like 30-40% or go for special type of properties like NDIS or co-living properties, which I personally don't recommend. But that's not necessarily a bad news. Negative gearing is actually one of the most loved strategies of wealthy investors. Why? Because you can get immediate tax deductions from year one. And then you can get 50% capital gains discount when you sell it, as long as you held the asset for more than 12 months. But let's be clear, negative gearing is a tax benefit, not an investment goal. You're not investing to make losses and just to get something back from the ATO, like a 30-40%, depends on your tax rate. That doesn't really make sense at all. Don't lose your money when you're investing. But the real goal of property investment is capital growth. Negative gearing is just one of the many tools that helps you ease the cash flow in early years. And that can be quite valuable as well. You watch this far, I want to tell you a little tip. You know the tax refund you get from the ATO from your negative geared properties is actually counted in your loan application. You know why? Because lenders like a bank assess your after-tax income when they assess your application. And that tax refund is actually after-tax cash flow, so it actually frees up a little bit of borrowing capacity when you apply for a loan for the next investment properties and whatsoever. It is possible because even if the property is negatively geared, your real-world monthly cash flow might look better than it does on papers because you get extra money back from the ATO. So it makes sense, right? So next time, if you hear someone says negative gearing sucks, ask them if they actually looked under the hood. You may actually think that, what are they trying to sell me here? The truth is, this needs to be assessed on case-by-case scenario. It's not something you can just stereotype. So now you know what negative gearing is, and you know what's the impact of having the negative gearing, even when you apply for a loan, right? I hope you actually got some value out of this video. I think this video is a little shorter than the usual ones, but this negative gearing, it sounds like everyone knows. But when you actually get into the little bit of details in your situation, what you know may not be applicable to your situation. So you need to actually assess yourself case by case. Just don't blindly listen to other people saying that, because that's just marketing messages, and don't buy into those biased information. So if you found this video useful, please hit that subscribe button and alarm button so you don't miss out any future updates from me. If you have any questions, drop them down in the comments below and I'll be more than happy to answer them. Thank you for watching, and I'll see you in the next video. Bye for now.